All right, man. What a week this week with the CPI, the FOMC, and the weaker labor figures in the jobless claims, man. Things seem to be slowing, at least on an inflation and an employment perspective this week. And the Fed, on the other hand, is looking for higher inflation, or at least they're seeing higher inflation in their forecasts. So very interesting, right? Like you'd have to think that the forecast that the Fed laid out in the dots was primarily weighted before they got a lot of obviously before they got today's data, and I think even wasn't really too influenced by Wednesday's CPI report.
Yeah, I'm kind of shocked that they pushed back the rate cuts. So they're saying the dot plot is saying only one rate cut for the year. And I mean, even just at the start of the year, we were saying that the Fed is already behind the curve. And what do you think about that now? Do you feel like they're even further behind the curve now?
Yeah, I mean, look, I don't think so. I honestly, I was, this is wrong, right? We were wrong. I was wrong for this, but I did think that we were going to see an unchanged dot plot this week. I really thought, look, like unemployment has been ticking up. And we even saw the unemployment print 4% on the last print, right? So unemployment is up. Um, Inflation is moderated very quite well since obviously the peak, and it's been disinflation in general has slowed a bit, but overall, inflation has not materially reaccelerated. Now, people will point to the face value and be like, oh, inflation's too high on the face value. But that's, again, the Fed's looking for more confidence on the direction to 2%. I think like they pretty much have it. I'm very surprised that we pushed that rate cut off the table. I honestly think that if the Fed would have gotten this inflation print, possibly even the PPI print as well, there would have been some sort of influence on these forecasts. Now, if we take a look on the forecast, and for those just listening, essentially all that happened here that really drove the push in the push of rate cuts off the table was an upward revision in PCE expectation. If you look at it, the change in real growth over the next 2 years is the same from March. It's unchanged. The unemployment rate is a slight tick down. We're talking about a slight tick up, excuse me. So 10 basis points higher. The Fed sees unemployment 10 basis points higher by the end of 2025 than they did at the March meeting compared to June. So that's a
What
worsening labor
what do
market
you think
theoretically.
is holding them back? Like, for example, CPI, what's really holding CPI up is core services. Do you think the Fed is just waiting for that to pull back? Are they kind of relying on core services to pull back, or are they looking at the unemployment rate and seeing that the unemployment rate is not rising enough for them to start cutting?
I mean, listen, we heard Powell say multiple times in the presser yesterday that the unemployment rate's still at in record low territory. So like they acknowledge the fact that unemployment's still tight, even though loosening or weakening, however you want to frame it, they're still implying that the unemployment rate is still um, wildly tight in terms of historical ranges. So they're not really. It's not at a point where it's like, oh God, we need to do something. Unemployment's really getting away from us. So they're looking at unemployment like again, they're seeing a weaker labor market in these revisions compared to the prior revisions, but they're also seeing a stronger inflation market. So like ultimately, what happened here is we saw rate cuts get pushed off the table really because of inflation, right? Like inflation is the only thing that actually went against the Fed in this last economic projection. And
But
I
it's
think if the
only
Fed,
core services that's going against them. Isn't it bad if they're just kind of relying on this one
no,
part of CPI?
yeah, but no, it's overall, right? So like, yeah, core services is the sticky part, but we're talk about PCE for the Fed, PCE, CPI. At the end of the day, PCE just realistically, CPI just trades higher than PC or prints higher than PCE on a face value, but they move in somewhat the same direction, right? That's at the end of the day, that's what we need to understand. So CPI, PCE, in this sense of this argument or discussion, is interchangeable. Now, PCE, you could see here, was expected to be 2.4 in the March projection for 2024. Now it's 2.6. So that's a push up on headline. On core, it's a push up on both core and headline. You see for 2025, 2.2 was the March expectation. Now it's 2.3. Same for core. So both PC and core are seeing upward revisions. These are the only things that have deteriorated or have gone against the idea of a Fed cutting rates. And that's what I think pushed the Fed up, pushed the Fed away. They want to see consistent or more directional improvement, at least on the face value, on the prints. And we'll look at the prints right now. And in turn, they want to see their forecasts come down too, or I should say, their forecast coming down would influence the expectation of rate hikes or rate cuts and remove hikes. And I think that they also, I mean, Powell basically said the forecasts are useless, which is just funny, right? He's like, yeah, the forecasts are just forecasts. They don't really mean much. They could change at any point. So then why do them? But that's their component of forward guidance. That's how they guide the economy forward in terms of where rates should go, what should drive the move, or where the market should expect the policy path to head in the near future. That's tool. Now, if you look at inflation here, I have this on a chart. But long story short, we saw this slowdown in this disinflation continue in the headline print, and we really saw core goods come down, or at least deflate more than they did in the prior print. And overall, we didn't really see core services pick up much. And everything really pointed to the fact that, look, disinflation is not over. It might have slowed, but it's definitely not dead. And I think that the Fed, if the Fed they noted this print a few times. They even noted that economists have the option to update when they get data in the morning before release. They have the option to update their expectations, but most do not. So like a lot of people were like, oh, the Fed saw this inflation print, it was irrelevant. I don't think they really accounted for it, to be honest. And I think that if we can continue to get prints like this or in this direction with the continued trend of disinflation, depending on the rate, 3 cuts might happen this year. As ridiculous as that sounds, or at least 2.
Do you
So
think
I
the
think we have
bond
to.
market is starting to pick that up? Because we are
Oh, of
seeing
course,
bonds starting to
of
move.
course, of course, the bond market's picking that up. It's noticing that, look, like labor. So this is another interesting perspective, right? The Fed is looking at the unemployment rate for 2025, the median unemployment rate for 2025, to be 4.2%. Right? We're at 4% right now. Like, if you look at the unemployment rate, like, look at where we are, right? So we started this year at we started this year at 3.7. We're at 4 in 6 months in. By the end of 2025, or excuse me, the median for 2025 is 4.2%. Think about that. That's 20 basis points higher from here. That's implying a very, very tight labor market, in my opinion.
Yeah. And as we know,
Right?
labor once
It's the last to go,
unemployment
right?
starts to rise, it can rise very quickly.
Yeah, it's the last to go. It's really like the most lagging part of the economic indicators, right? So this already gives me like a red flag. I look at this and I say, okay, hold on. Wait 1 second. We got 4% unemployment rate here for 24. We're already there. It's a median, right? So understand that. So like, okay, like it's not, this makes sense, maybe. But we're halfway through the year. But 4.2 for 25, like this could easily be higher. And I think that any sort of slip in jobless claims, we saw that today, right? Like if we look at the Fed funds futures just today, where here we so we look at the Fed funds futures for today. We essentially, what happened yesterday on CPI, on the cooler than expected CPI print, we priced back in those 2 cuts pretty quickly, right? Like in term, we priced in, or at least tried to price in those 2 cuts back in pretty quick. And what ended up happening is the Fed came out and dropped the dots, and then the market just got stuffed. But today, we actually tried to basically fill back that wick. And I think that this move obviously was driven by the higher than expected jobless claims and the weaker PPI, both of which are a signal that the economy's path is continuing to soften. That is something that, again, is a signal that the Fed is restrictive. I know there's a lot of people out there, and a lot of you guys are listening, to a lot of different things, which is good to basically absorb as much knowledge as possible. But there's a lot of people out there claiming the Fed is nowhere near restrictive. I think that's nonsense. And we've been very vocal about that. Like, I mean, again, let's look at unemployment. And we can claim, like, yes, unemployment is still, pretty low in historical standards, right? But just remember, like, it's low today, but it's been rising. And I think that it can continue to rise if the Fed stays put. Now, the problem is when the Fed figures out that inflation is certainly on trend and unemployment's likely looser, there's a risk now that continues to grow, and it's been growing for the last couple of months. Like you just said already at the beginning of the podcast, like we thought the Fed should have started cutting months ago, but the Fed is the Fed. They're going to do what they want to do. But ultimately, the risk is real now that they're going to blow the top. They're going to blow over the end here, and they're going to end up in a policy enacted recession at some point, and then we get some sort of QE if given inflation falls low enough, or at least a complete stop to QT. That would obviously be the first thing that comes up, right? Rate cuts and a complete stop to QT, or a vast slowdown to the point where it's negligible, and then we get the stimulus out of that, whatever that may be. But I think that we can't go that far ahead. Obviously, the economy is still somewhat it's strong but softening. So yeah, like real GDP is still up there, but obviously as inflation slows and unemployment picks up, ultimately if this trend continues, you're going to see that bleed into growth at some point. And I think that if the current pace, the Fed has a decision to make. Do they want to cut rates, or are they going to try and wait this out as long as they can? And that's my opinion. My opinion behind this whole FOMC press release that basically the dots caught everyone as overly hawkish by surprise, or most people by surprise, is that at least the ones that don't believe the Fed is, or the ones that believe the Fed is restrictive enough, caught those people by surprise. I think the game here is the Fed's at a point where, like, they know the second they cut interest rates, the second they do, right? As soon as the first 25 basis points, the market is going to run with that forward guidance. Even if they say we're cutting once and we'll evaluate meeting by meeting, the market's going to run. If it's a cut the market's likely going to base at a minimum at one cut every meeting, just like that. Boom, instant print, I would assume. And the Fed is not trying to loosen forward guidance that quickly because they're in a position where, like, they can hold and they can play around now with the dots, right? They can play around with forward guidance at this point because it's the last thing they can do without hiking and before they have to cut. You're in the point where the Fed is not going to hike anymore. They're pretty much telling you that you're not going to hike. They're going to say they can't rule it out, but they're not going to hike, right?
Yeah.
And
I think they've kind of put themselves in a position where I feel like the hard landing is actually a lot more possible now than it was at the start of the year. Whereas now
100%.
it's like they can come out with a cut. That's not going to do anything. If unemployment is really starting to rise and growth is slowing like what we were seeing, and it starts to accelerate, one cut every meeting is not going to be enough to reverse that. That's when they're going to get into that panic cut territory, and it seems like they're kind of putting themselves in that position just to be safe because they really don't want to risk a second inflation wave.
That's a great point, and a way to illustrate that is we can look at the Citigroup economic and inflation surprise indices for the United States, right? So one measures economic data overall, the other one is inflation related. So what you can see here is on the economic side, and for those listening, the economic side is negative. Okay, it's been negative for some time now. So what it's telling you is not necessarily that growth is materially slowing or it's recession. You don't jump the gun like that. It's telling you that expectations are above prints, meaning prints are below expectations, right? So prints are coming in weaker than where people are expecting. Typically, that's the start. That's what happens at the start of the slowdown, right? Expectations stay strong, and then the prints come in weaker and weaker and weaker. And then before you know it, the prints are now weak themselves, but they first miss expectations. So that's a sign that, look, okay, we didn't see a negative print on this index the entire year of 2023, pretty much. And now we are in negative territory for a good period here. So there's a considerable slowdown in reported versus expectations, which again is an early indicator of possible slowing. On the other hand, we have inflation, the inflation surprise in positive territory. So what this is telling you is the Fed's in a position right now. Now, some people are going to say, oh, stagflation, negative economic surprises, positive inflation surprises. Again, not how this works. Inflation has come down greatly. Disinflation has been running great overall since 2022, right? In terms of where we've come on the inflation prints from 9 down to 3. Phenomenal run in disinflation. But we started seeing that inflation was printing above estimates or above consensus for some time now. Now, it wasn't blowing out like it did in 2023. And you could see that by this chart, right? It wasn't 2021, excuse me, 2021, 2022. In 23, we were getting that massive disinflationary wave where we were blowing under. Like now we're getting up, but it's still nowhere near what we were seeing in the inflation run in the last 2 years. But nonetheless, inflation coming in above estimates. And that scares people because now it's like, when does it stop? Does it keep going? So if you look at it from a perspective like this, you have I don't even want to say hotter inflation because theoretically it's hotter inflation, but it's not inflation at 9%. It's inflation, we're talking about a couple of basis points over estimates, but it's still above estimates and it's going to put a positive trend score on this index. And we zoom out and you get a situation where like growth is softening, as you can see here, at least it's starting to, and inflation isn't. And the Fed doesn't really care about growth unless it's bleeding into unemployment, right? Because it's a maximum employment or maximum price stability mandate, or maximum employment and maximum price stability, mandate. They want that balance. So they're really focused on one side here. And I think that if we didn't get those marginal surprise prints on expectations, where, if you look at headline CPI, it's ridiculous. Like we talk about surprise, right? Look at the surprise index. It looks pretty bad since 23, right? Really lifting up off the lows, but that's just a snapback in expectations where you look at actual prints, like the inflation's gone sideways. Disinflation has slowed, but overall seems to be running within inflation in terms of core goods, etc. But overall, like inflation hasn't materially reaccelerated. That's a false statement, right? So I think that just the fear in the public, the idea is the Fed doesn't want people to get scared and fear higher inflation, because when you fear higher inflation, generally inflation does go up because there's an emotional mechanic behind inflation. And I think that because prices rise, people will raise prices, etc., because they fear higher prices are coming. And this is something that I think that once we get past and we can see CPI take out on a rate of change basis, take out the threes, right? Take out the lows here, at least break below. I think that will relieve a lot of. I mean, I think we're going to be talking about actually, a cut at every meeting for the foreseeable future if we can do that, or a cut every other meeting. The Fed will be very vocal about that because at that point, inflation is broken down, and they're going to be more driven to. I'm not saying 2.99. It's the rate cut galore. You get my point that the Fed will be very open to cutting rates if we can really break below 3. Until we see that, though, the Fed's running the risk of sitting too tight for too long, and then they get caught sideways, like you just said, in a disinflationary wave where disinflation starts picking up aggressively, and they're running to cut rates. We're talking about inflation in the 3s, Fed funds in 5.25. We're talking about a difference here of one rate cut every other meeting is 100 basis points in a year, right? So you're talking about, even if they start today, by next year, this time, they'll only be at 4.25. That's still 100 basis points above where inflation is right now. That's
Yeah.
a cut every other meeting. So it's very interesting to see how they're going to play this. Like, are they going to come out and start doing 50 clips? We'll have to see that part. But, everyone likes to talk about Eurozone, right? Oh, Eurozone's cutting. You look at Eurozone. They did not get that inflationary push that we saw in the States. Their economic surprise index stayed negative, meaning it continued to just print below estimates. Meanwhile, their growth picked up a little bit. They started printing above estimates, but the Eurozone's in a position where inflation just didn't get that type of I should say estimated reacceleration or consensus reacceleration, because it really didn't reaccelerate in the States either, but estimates were not high enough to accommodate the prints that came in, and that margin of difference got people scared. Ultimately, inflation is not problematic at the moment. We make that very clear. I mean, you can just see this is not. We're talking about 127 basis points over Fed target. Like, oh my God, that's huge, right? People are going to pitch doomsday about this. But let's be honest, we were at like 8% 2 years ago, right? Or a year and a half ago, excuse me. Like, at what point do you acknowledge that inflation has made great progress? Even though it's not perfect, it's substantially lower in terms of rate of change, and growth is not materially declined so far. These are all
Yeah.
good signs. The Fed should be moving into this. The Fed should be leaning into this slightly, but
Well,
they're not.
something interesting that I noticed during FOMC was Bitcoin. So going into it, um, I think I think Bitcoin was liking where the Fed was going at first, and then they kind of started giving the whole higher for longer scenario and the cuts getting pushed out and everything, and then Bitcoin got stuffed. Um,
Yeah, yeah.
what do you see in this? Like, to me, this tells me that Bitcoin is seeing a growth slowdown coming and seeing that the Fed is staying too restrictive for too long. That's what this is telling me, because Bitcoin at the end of the day is very much a growth proxy and kind of a free money proxy. If there's high growth and there's a lot of money floating out there, that's when Bitcoin excels.
So this is my theory. I think the markets were, so if we just even look at the Qs, right? The Qs were, they closed higher today, obviously, but they were up and got stuffed too. It wasn't just Bitcoin, right? But I think ultimately what happened was everyone saw the dots at first, right? The dots, and they were like, okay, the thing holding the dots back here, the thing preventing us from those three rate cuts that the Fed saw in March is that PCE revision higher. That's it. That's really it. So if that's the case, we just had cooler CPI in the morning, decently. I mean, again, remember we just saw CPI with a pretty much a 3.25 print. So cooler print there. Okay, we know that there's a chance that PPI could be cooler tomorrow. This is as of yesterday, right? And possibly higher than expected jobless claims are always possibilities. The market's like, okay, the Fed's in a position here where they definitely did not account for the last inflation print in this PCE forecast. They definitely, I mean, Powell basically said that pretty much nobody updates the forecast, right? So the market's like, okay, there's probably just a reviewal error here. Powell will likely be dovish on this because of the CPI print. And what you'll notice is we go into Bitcoin, right, in a 15-minute. As soon as Powell pretty much starts to, like, what you'll notice is 2 p.m., right? So where is this yesterday? Right. So let's see. Bitcoin goes up in the morning on that inflation print. And then down here at 2 p.m., it sells off as the dots are released. It doesn't really do much. And then at 2:30, when Powell starts speaking, that's when the dump happens. It wasn't until Powell started speaking that Bitcoin took a dive. And that's primarily, again, because I think that the market saw the dots and we're like, okay, it's simple, easy. The Fed just didn't count for inflation. Okay, probably going to be dovish. That was my assumption too. And Powell comes out more hawkishly than expected. And really just, he tries to put some dovish components in there saying like, oh, any type of gradual shift in unemployment would require us to revise our forecast. Yeah, okay. But you could have been a bit more dovish, right? And the fact that he wasn't, I think the market kind of picked up on that, even on the Qs, right? You saw that even on the Qs. Once Powell started speaking, it was pretty much like into the end of the day, it was down. And I think that again is due to the fact that initially the market was more open to the idea of a wrong dot plot and the Fed backing the story with reality in the presser, but it just didn't happen. And I don't think that, could we get one rate cut this year? 100%. Like the Fed could, I don't want to say 100%. The Fed could easily just walk around here and try and do one rate cut and just stay sticky. And I think the market is kind of calling that bluff. I mean, we're already seeing, like I said earlier, on the on the Fed rate expectations, if we just take a quick glance at them again, the Fed funds futures, we're seeing the Fed like it already priced back out. Like where it finished on Wednesday, we're already higher. Now we'll see where we close today for Friday session, but ultimately the market's like accepting the idea that look, we might get one rate cut, but then bonds are even moving, right? So we were just speaking about bonds. Like bonds are up. These are all signs that are like, okay, the market's sensing some sort of growth slowdown. And obviously, as soon as the Fed gets some sort of clear signal there, maybe it's um, maybe it's going to take real GDP estimates to fall, but whatever it may be, then they're going to start bringing cuts back on the table. And the bond market is always going to front run the Fed. It's going to try its best, especially long bonds. Are going to try and front run the Fed to the best of their ability. So right now, we are bullish. We are, excuse me, we are above Momo, still bearish trend on long bonds. So the bullish trend trigger isn't there just yet, but it could very well turn at some point here. And then it comes down to the system. That's when you need to be watching the system like a hawk, because that will drive and tell you what the highest probability is going to be for bonds in the next couple of months to weeks, however you want to decipher it, but it'll give you that short-term to midterm direction. And that's where we start executing and start swinging if we get those signals. So make sure you're paying attention to the quant deck. You're watching the system updates like a hawk, because we're getting to the point where we could be shifting regimes. Not going to say we are, but it's very possible that things could start progressing here under the surface if bonds really keep this bid, right? And they just start bidding up and they are really firm, and we start to see that growth really deteriorate. Again, our system's likely going to pick it up before the Fed does. It's just how this works. And if we start to see that growth deterioration really click in, at that point, it's likely the bond trade emerges.
Yeah,
So watch
bonds,
this
honestly, they seem like this is the most favorable they have been in the last 2 years.
right now. Yeah, I mean, in terms of like, look, the Fed's basically telling you no rate cuts are coming, right? And I think like that all started even at the last meeting, right? So like even in March, we like the Fed said that they weren't going to cut rates. They weren't going to hike rates. Like rate hike was not the next move. Bonds sold off initially, but they're back. They're back up. I mean, the bond market's like getting the feeling. I mean, you're seeing higher lows here. Yeah, it's not bullish trend yet, but you had this first real pullback that again, October 23 lows. Now you got these April 24 lows, and you're getting this formation in here where like if we go bullish trend and the system really clicks in, like we could get that bond trade that everyone's been so desperately looking for. But again, the system needs to align. This is the beauty of having a multi-input model, right? So you have to have multiple boxes checked. The stars need to align, and then you swing for the fences. And that's why we use leverage and we strike big when the conviction's there. So we're going to continue to eye the system, keep our eyes on the market here, and just watch as the economy navigates these waters where the Fed is in fact restrictive and refusing to acknowledge the fact that they really should be cutting rates, or at least guiding to cutting rates. Instead, they are playing the sit and watch and see game, and that is something that likely, if they continue, will put us into stage 4 of the compound landing, and in turn drive a policy-based economic slowdown. I don't know if it's going to be a recession, but it might be enough. Even it will probably be enough to put a bid in bonds, and I think that's where the potential trade emerges if we see the signals click in. But thank you guys so much for listening this week. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com. Thank you.